In our report this quarter, we will review CLS portfolio performance and discuss whether investor expectations need to be tempered in the U.S. stock market. We'll then turn to the bond market and review the impact of interest rates on portfolio risk. Finally, we'll explore international opportunities. Welcome to the CLS Market Outlook for the second quarter of 2017. I'm Ryan Beach. To begin, please welcome our Chief Investment Officer, Rusty Vanneman. Rusty, welcome.
Thanks, Ryan. Good to be here.
So let's start at home. What are you seeing when it comes to the U.S. stock market?
All right, well, the U.S. stock market's had a heck of a run the last couple quarters. A little bit soft to finish off the quarter, but really we're on a great stretch, and it's been a great bull market so far. A couple things to say about it, and it's very typical of this stage of a bull market. First of all, investor sentiment is pretty bullish right now. And what's really interesting, when sentiment gets this bullish, what happens to stock market returns moving forward? Still positive, but below average over the next 3 months, 6 months, 12 months, 3 years. So just to add just a little bit of caution there. A second thing about the markets right now is that valuations are a little bit stretched in the U.S. Again, we've had a gray bull market, and so it's just going to make sense that valuation is a little high. Again, that doesn't mean that returns have to be negative. It just means that returns will probably be below average. Something else I want to point out about sentiment, which is really interesting, and this actually ties into CLS portfolios as well, is that right now when they do surveys of portfolio managers, right now on average, U.S. portfolio managers are overweight like U.S. stocks. They're overweight larger companies. They're underweight bonds. What's interesting at CLS, it's actually we're the opposite of all of those. We're overweight international instead of U.S. We're overweight smaller companies over large. And so we're just a lot different. I think that kind of ties in the way we manage money at CLS is that we tend to be different anyway. We are, as you know, one of our themes is smart beta. We're overweight smart beta. We're overweight actively managed ETFs. We're overweight thematic ETFs. We even use currency hedged ETFs more than other people. We're overweight alternative ETFs relative to other people. So again, we're cautious on the market, but again, we're just doing different things than other people right now.
Great.
Yeah. The bond market is another story, however, as we have two strong reasons not to walk away. Recently, Josh Jenkins and Joe Smith sat down to discuss.
Josh, let's talk a little bit about an asset class where investment sentiment clearly is negative right now. In fact, really negative. Obviously, we're talking about U.S. bonds. For example, I don't know about you, but I've clearly seen a lot of articles out there around short-term interest rate environment in terms of rising rates overall. Clearly, investors right now aren't as favorable in fixed income due to the low interest rate environment. We've also seen a lot of fear mongering, if you will, when it comes to short-term interest rates moving higher because of Federal Reserve policy now. But with that as a backdrop, though, why don't you tell me a little bit more about why investors should not be bailing on bonds?
We think there's two pretty powerful reasons why investors should stick with their bond allocations. The first relates to just our general positive return expectation, and the second is all about diversification.
Right.
If you think about the last 14 cycles where the Federal Reserve was increasing interest rates, and that goes all the way back to the 1960s. 12 of those periods, the bond market was still able to eke out a positive return. That's about 85% of the time. So really, we think that history is not as scary as what many investors are trying to project into the future. It's important, I think, to remember that the best overall predictor for bond returns moving forward is the current level of yields. Right now in the U.S., yields are low by historical standards, but they're still positive. And we think that because of that, investors should still have a positive return expectation. Even if you consider the current rate hike cycle we find ourselves in, starting in December of 2015, the Fed has increased rates 3 different times, and yet over that time period, the bond market has still had a positive return.
Right.
Again, the second reason is it's all about diversification.
Right.
If you consider historically, stock market losses are much, much larger than what you would see in the bond market. And if you really focused in on a period where there was a large equity market drawdown, what you would see is that the bond market has had pretty strong performance on average, And that includes periods where interest rates were being hiked by the Federal Reserve.
Right.
So at the end of the day, we think it's very important for investors to remember that bonds are there to help manage and diversify portfolio risk. If you try to eliminate risk within your bond portfolio, you're going to leave yourself overexposed to the much riskier equity market.
All great points, obviously, and clearly something that we try to incorporate and think about within CLS portfolios. So thanks, Josh.
Turning now to international stocks, assuming the S&P 500 and large U.S. growth stocks do start to lag, then it's highly probable that international stocks will be outperforming. Here now with a report on what to expect in international stocks is Paula Wick and Kostya Edis.
So, Kostya, we have new international slides in our reference guide.
Yeah.
I'm really excited about
Me
them.
too.
We haven't seen these before, so tell us a little bit about these.
What it shows is U.S. performance relative to international markets. So one unique thing we've done is we've put it on over a 0% line, which means when the U.S. is outperforming, it's above 0, and when the international markets are outperforming, it's below 0. So what you see is a very clear cyclical pattern over time. And this is going all the way back to the 1970s, so there's plenty of data. What we did is we've evaluated each one of these cycles and determined average periods of length of each cycle, as well as performance. One unique thing about the current cycle is that it's really been stretched out. The current cycle in the U.S. has been going on since the financial crisis of 2007, and that's a 112-month cycle.
Wow.
That is well above the historic average, which happens to be 66, exactly half of that. And performance since that period has been about in line with historic averages. So what does this mean? Well, because the cyclical period has been so stretched out, there's a higher likelihood of reversion to the mean. In other words, there's a higher probability of international markets outperforming domestic going forward. Now, speaking of cyclicality and mean reversion, I hear there's another new slide that deals a little bit about U.S. dollar outperformance.
The U.S. dollar, it has been on a tear since the financial crisis, and it's actually overvalued by about 17% to
Wow.
a basket of international currencies. And so what that tells us really is a couple of things. First of all, what we know is that whenever the U.S. dollar is this overvalued, the probability of it continuing to strengthen goes down considerably. And so we think that there's actually a higher probability that the dollar is going to weaken. The other thing that's important with this is that the U.S. dollar and U.S. market returns are highly correlated. And so if we anticipate that the U.S. dollar is going to weaken, that doesn't necessarily bode well for U.S. market performance, especially compared to international markets going forward. So I have to ask you, so if you were an investor, where would you want to be invested?
Well, based on everything we've talked about, it sounds like international is the place to be.
You betcha.
That concludes our outlook for the second quarter of 2017. Our next outlook will be this July. Also, check back with us at the beginning of each month for our monthly market review, through which we'll give timely updates on portfolio positioning and how we're specifically applying our investment themes. For all of us here, I'm Ryan Beach. Thanks for watching, and thank you very much for your time and trust in CLS Investments.